Okay, so today we are looking at money market. So money market is the market where you buy and sell short-term securities. So at the end of this lecture on money markets, you should be able to describe the features of the most popular money market securities. You should be able to explain how money markets are used by institutional investors. You should be able to explain the valuation and risk of money market securities. And you should also be able to explain how money markets have become globally integrated. So money markets, generally, they are debt securities with a maturity of 1 year or less. So the key word is maturity of 1 year or less. Compared to the long-term securities, they can mature in 5 years or more. But the key features of the money market security is that they mature just within 1 year. So they are liquid. So once you buy them, if you need money within a year, you can sell them and you can collect back your money. So it's very liquid. It is also issued primarily in the primary market through telecommunication network by the Treasury, corporation, and financial intermediaries. So these are the people that issue these securities. It is issued by government treasury. It is also issued by companies as well as financial intermediaries that wish to obtain short-term financing. This security is commonly purchased by household. So household means investors that requires, that wants to invest their money for some time. So it could be household, it could also be companies or government. These people, they have funds available for a short time period. That is, instead of keeping the money in the Maybank or CIMB, for example, where the interest rate is very low, they can decide to put it in the money market so that they can earn slightly higher rate than putting the money in the Maybank or CIMB without getting much additional money on their savings. It can also be sold in the secondary market. Because it is within 1 year, you can sell it within that year, so it is liquid. 1 year is considered short enough, so you can sell it and make your money. So this flow chart shows how the money is exchanging hands. You can see that the household, the corporations, the government agencies that have short-term funds available, they can use this money to buy treasury bills. They can also use their savings or their short-term funds to buy money market securities from the companies. They can also use their short-term fund to buy money market securities also from financial intermediaries. So the US Treasury, the government, they can use this money to spend on government programs, because by buying, they are providing money to the government. So the government will have excess some money to spend on capital project. Companies will also have some money for their business expansion. So you can see, basically, it is this group of people, household, corporations, and also government agencies that provide the finance to do all this investment. It is also possible for the financial intermediary to also loan to corporations. Sometimes those who want to invest their money, they don't go direct. They can also go through financial intermediary. So the financial intermediary will not give the loan to the corporations. Or sometimes the household, they don't want to go direct, so they can also go through the financial intermediary. So the financial intermediary will also give the loan to household. Then the household will use the money for their own spending, buying of house, buying of cars. So this is how the money flows from those who have excess money to those who are in need of money for investment and capital project purpose. These are the list of popular money market securities: Treasury bills, commercial paper, negotiable certificate of deposit, repurchase agreement, federal funds, and bank acceptances. So 1, 2, 3, 4, 5, 6. So we'll look at them one by one. So starting with the Treasury bills. So Treasury bills is the most liquid and it is less risky because it is issued by the government. So it is issued by the government. So in the case of the United States, it is issued by the US government. In the case of Malaysia, it is issued by Bank Negara. So it is considered less risky because there will always be Bank Negara. There will always be US government. So they can always honor their obligation. So default rate is very low. Once you buy the government securities, you are sure of getting back your money within 1 year. So the Treasury bills can be in different periods. It can be 4 weeks, it can be 13 weeks, it can be 26 weeks. So within 1 year, you can invest your money and still make some returns. The par value of the Treasury bills was historically a minimum of 10,000, but now it is 1,000. So usually this money market security, they have par value. So their par value is now regarded as 1,000. So in most cases, it is denominated in 1,000 unit. They can also be sold at a discount. Sometimes, if the person selling wants to reduce cost, they can sell the Treasury bill at a discount. So meaning that you can buy cheap. Concerning the risk of the Treasury bills, so it is backed by the government. So because the government will always exist, it is unlikely that the government will default. So the default risk is very low. And sometimes they also call it risk-free security. It is also highly liquid. Why? Due to the short maturity and strong secondary market. So because anytime you need the money within a year, you can sell back and get your money. So you can see 4 weeks is just 1 month. So even though you invest for 1 year, you can decide to change it back to 4 weeks, 1 month only. You can collect back your money. So highly liquid. So these Treasury bills, those who invest in Treasury bills, example of them are depository institutions. So depository institutions here refers to, for example, Maybank in the case of Malaysia, CIMB, and all these banks that accept deposit from the people. So when you deposit money in CIMB in Maybank will not just keep the money in Maybank. Maybank will use the money to invest in Treasury bills. So when they make some higher returns, then they can pay back to those that needs cash regularly. So that is what they do with the money. So individuals also with substantial savings, they also invest in money market. Maybe there are some individuals who earn more salaries. They are unable to exhaust all their income. They can decide to invest part of it in the money market. Because it is backed by the government, it is considered less risky and it is highly liquid. You can easily sell it. So in terms of the pricing, how the money market securities, particularly Treasury bill, is priced, it is priced at a discount sometimes, meaning that it can be sold cheaply. It can also be sold at a premium. So premium means expensive. So at a discount means cheaper. So this price of Treasury bills depends on the investor's required rate of return. So the required rate of return will also affect the price of the bond. So the value of the Treasury bills is the present value of the par value. So if you look at this equation here, for example, if investors require a 4% annualized return on a 1-year Treasury bills with a 10,000 par value, so the price that they are willing to pay would be, you can see, the par value, 10,000, divided by 1 plus I. 4% is 0.04 plus 1, 1.04. You can see. So this is the price, 9615.38. So if the required rate of return is, let's say, 10%, so this price will reduce. It will reduce. So the higher the required rate of return, the lower the price. So that is why the required rate of return determines the price of the treasury bills. So you can also estimate the yield. So to calculate the yield on the treasury securities, you can use this formula. So this yield, to calculate this yield, this one, this 4%, for example, you can use this formula. You can use this formula: selling price minus purchase price divided by purchase price times 365 divided by n. So you convert the month that you want to keep it. Since you are not waiting up to 365 days, so you calculate in months. So if it is 1 month, that's 30 days. If it is 2 months, that's 60 days. If it is 3 months, 90 days. So this is how you determine the n. You can also find the estimated treasury bill discount. So to calculate the discount that you receive, you'd subtract the par value minus the purchase price divided by the purchase price multiplied by 360 divided by n. So take note of the difference in the formula. 365 is used for the estimated yield, whereas 360 days is used for estimating the treasury bill discount. 365 days means 1 leap year. Yeah, but sometimes it can be 365 days, sometimes it can be 360 days. So in terms of how the treasury bill is functions, investors can submit their bid online for newly issued treasury bills. So if investors, they are interested in buying the treasury bills, they can show interest by submitting their bid online. So investors have the option of also bidding using competitive approach or non-competitive approach. So competitive approach means that anybody who is interested, they can show their interest. Then the government will decide who they want to sell to. Another type of money market securities is called commercial paper. So commercial paper is mostly issued by companies, and it is considered more risky compared to the treasury securities. So short-term debt instrument issued by well-known credit-worthy firms, and is typically unsecured. You can see it's unsecured means that it is risky because companies can bankrupt. Bank Negara may not bankrupt because they are government. They will always look for a way to print money or get money to pay back. But companies may bankrupt. And if they bankrupt, it's difficult to collect your money back. That is why they say they are unsecured. Normally issued to provide liquidity or to finance a firm's investment in inventory and account receivable. So most of the companies that use commercial paper to raise money, they use the money for their short-term needs. It is usually denominated in hundreds of thousands of dollars in the case of the United States. So maturity period is usually between 20 and 45 days, but it can also be as short as 1 day or as long as 270 days. So you can see it's also liquid. So in terms of the default risk, it is issued by corporations, and these corporations or companies, they are susceptible to failure. Therefore, they are subject to failure. So meaning that because commercial paper is issued by companies, companies can go bankrupt. So it has a way of increasing their risk. So risk is affected by issuers' financial condition as well as cash flow. So if the companies is having financial problem, it's going to increase the risk of investing in in commercial paper. So in terms of rating, so there are rating agencies that help the investors to know which company is risky and which company is not risky. So these are rating companies. They have done a very good job. So you will see in the next slide. So they provided ranking for companies. So any company that is ranked as P1 is considered very good. So you can invest in commercial paper of the companies. So you can buy commercial paper of those companies. But if the company is rated as NP, it means default risk is very high. So most investors will avoid buying commercial paper from this type of companies. We can also use another rating agency called the Standard & Poor's. So it is the same. The only difference is the notation. The alphabet is different. In the case of the Moody, they use A1 for the highest quality. They use D for the lowest quality. So any company that is with D grade, it means it is risky to buy their commercial paper. So you buy the commercial paper of the companies who are at least in the B category. C also is considered not good, but A1, A2, A3 is considered okay. There's another rating agency called the Fitch. So the Fitch, they use F to denote their ranking. So F1 means the highest quality, F5 means the lowest quality. So commercial paper, in terms of placement, for firms place commercial paper directly with investors or rely on commercial paper dealers to sell their commercial paper. So the company can either sell directly to the investors or they can also sell it through dealers. So they will sell it to the dealers will sell to the investors. So this commercial paper, there's a backing of commercial paper. Some are backed by assets of the issuer. That is, the issuer will say, okay, if I default, I can sell my asset to pay you back. So this type of commercial paper with backing is considered safe. But the issue is that they offer a lower yield. They offer a lower yield. That is, they offer a lower return. Why lower return? Because the issuer or the seller of the commercial paper is already reducing your risk. The lower the risk, the lower the return. The higher the risk, the higher the return. So because there is asset that is already used as a backup, if there is default, of course, you will get a lower yield in return. So issuers of commercial paper typically maintain backup lines of credit because to minimize the default risk. In terms of yield, commercial paper does not pay interest and is priced at a discount from par value. So sometimes it can be sold at a very cheap rate, deeply discounted. The yield on commercial paper is higher than the yield on Treasury bills. The reason is because the commercial paper is considered risky. So that is why the higher the risk, the higher the return. So the yield is higher than Treasury bill. Why? Because Treasury bills is more liquid and it is issued by the government. So governments are unlikely to default. So commercial paper also has a yield curve. So this yield curve represents the yield offered on commercial paper at various maturity. The same factors that affect Treasury yield curve also affect commercial paper. Actually, Treasury bills and commercial paper, you will see later, they move closely. Factors that affect the Treasury bills also affect commercial paper because they are short-term securities. So what is the commercial paper rate over time? So commercial paper is highly correlated with Treasury bills with the same maturity. Say if the Treasury bills is 1 year, for example, and the commercial paper is 1 year, they are highly correlated. They move together. So this is commercial paper rate over time. You can see in 1998 it was 5%. In 2000 it drops to about 4.7. Then going up. Then in the crisis of 2002, the shaded region means crisis. You can see that the commercial paper rate declined during crisis. Then you can see that later on it started to increase, and close to 2007, there was another crisis, the United States crisis. You can see that the Treasury, the commercial paper rate also declined, very close to zero. So crisis period is always a challenging times for commercial paper. Many people will not want to buy it because they are scared that there might be higher default rate during this period. Another type of money market securities is called negotiable certificate of deposits. So it is certificates issued by large commercial banks and other depository institutions as a short-term source of funding. It also has a minimum of $1,000. You can also buy more than that, but the minimum is $100,000. So maturity on negotiable certificate of deposits is normally ranging from 2 weeks to 1 year. So you can decide to purchase negotiable certificate of deposit with 2 weeks maturity or with 3 months maturity. But the key point is that it must not exceed 1 year. And there is also an active secondary market for NCDs, meaning that at any time that you need money, you can sell back the certificate of deposit and you can collect back your money. It can be sold at any time. So it makes it more liquid. So once you have this certificate, if you lost it, you have lost money. So it has to be kept properly, especially if you invest large amount of money in them. So the certificate given to you is the evidence that you have given money. So when the time comes for you to collect back your money, you show them these certificates and they will give you the value of your investment plus extra return. So negotiable certificate of deposit, it also has placements. Some issuers, they place their NCDs directly. They can decide to sell it directly to the investors, or other use will now sell it on their behalf. To calculate the yield of the negotiable certificate of deposit, we use this formula: selling price minus purchase price plus interest divided by purchase price. It is mostly offered at a premium. So unlike the Treasury bills and the commercial paper that sometimes offered at a discount, the negotiable certificate of deposit is usually offered at a premium above the Treasury bills. So meaning that it is considered risky compared to the Treasury bills. So the return is higher than Treasury bills. So the higher the risk, the higher the return. Another type of money market securities is called repurchase agreement. So repurchase agreement, one party will sell securities to another with an agreement to repurchase the security at a specified date and price. So this repo is a guarantee that, okay, I sell to you, but I also give you an assurance that anytime you need the money, I will buy from you. That is how it works. We also have the reverse repo. The reverse repo is the purchase of security by one party with the agreement to also sell them. So in the case of reverse repo, once you purchase the securities, there's also an implied condition saying that you can sell them back to the same person. So you don't need to start looking for who to sell to. You can sell back to the same person that you bought it from. So a repurchase agreement or repo represents a loan backed by the security because there is assurance of who you can sell it to anytime that you need money. So financial institutions, they often participate in these repos. And the size of repo, it has increased significantly up to 4.5 trillion. So it shows that many financial institutions are actually using these repurchase agreements. And the most common maturities are from 1 day to 15 days. You can see that the maturity period is very short. So within short time, you can actually invest and actually make good money. So repurchase agreement can also be negotiated in terms of how it is bought and sold. It can be negotiated through a telecommunication network, through just simple click. You can get it placed, or it can be through the dealers and repo brokers. You can approach them, then they will act as financial intermediaries to create the repo for firms with deficient or excess fund. So either directly or go through intermediary. Now, this repurchase agreement, there is impact of the credit crisis that affected it. Many financial institutions, they rely on the market for funding. We are not able to obtain funds. So investors became more concerned about the securities that were posted as collateral. So there was a problem during the crisis period, and it affected this repo placement. In terms of estimated yield, it's similar to the way we calculate for the treasury bills. Selling price minus purchase price divided by purchase price times 360 over N. So you'll be given all this information and you can just do the mathematics. You can get the answer easily. Another type of money market securities is called the federal funds. Now, these federal funds is used in the case of the US. It enables depository institutions to lend or borrow short-term funds from each other. So depository institutions refers to banks. In the case of Malaysia, you have Maybank, CIMB, RHB. So these banks, sometimes they can also lend each other money. They can lend each other money using the federal fund rate. The Federal Reserve adjusts the amount of funds in depository institutions in order to influence the federal fund. So sometimes the federal fund, or in the case of Malaysia, Bank Negara, they may want to influence their federal fund rate. They can either increase it or they can decrease it. So by increasing and decreasing the rate, they are also affecting the amount of money available for the depository institutions to trade with. If they increase the rate, there will be lower fund to trade with. If they reduce the rate, there will be more fund for the commercial banks to trade with. The rate is normally slightly higher than the treasury bill. So most of all other money market securities, they are slightly higher than the treasury bill rate. Why? Because the treasury bill rate is considered less risky because it is issued by the government. Government will always exist. So federal fund also price slightly higher than the treasury bill rate. So commercial banks are most effective participants because they can use this rate to lend to one another. The volume of interbank loan on commercial bank balance sheet over time is an indication of the importance of lending between depository institutions. So these banks, they lend each other money. They lend each other money. The last type of money market securities is called bankers' acceptance. So this bankers' acceptance is usually used in international trade because in international trade between the importer and exporter, sometimes the importer may not know the exporter and the exporter may not know the importer. So the importer may just find information of the exporter and will contact the exporter to send some goods. So the exporter will be scared. What if I send the goods and this person happens to be a scam? So to reduce this problem, this concept of bank acceptance comes into play. So since you don't know the importer, you can tell the importer to give you information about the banks that is going to use. So you now will deal it because banks are more careful in accepting dealings with others. So by allowing the banker of the importer to transact with your own bank as exporter, you eliminate the risk between selling directly to the importer without knowing him. So it indicates that a bank accepts responsibility for a future payment. So if a bank's promise to pay you is more reliable than if an individual importer tells you, send the goods to my country, I will pay you. You will not believe him. But if the bank says, don't worry, send it, I will pay, it's more credible. So it's commonly used for international trade transactions. For example, the exporter can hold a banker's acceptance until the date at which payment is to be made. But they frequently sell the acceptance before then at a discount to obtain cash immediately. So because banks are involved, if the exporter needs money urgently, he can immediately sell and get his cash. Of course, there will be a price for collecting the money much earlier than before. So because acceptance are often discounted and sold by the exporting firm prior to maturity, an active secondary market exists. So meaning that the exporter, let's say it will take the exporter roughly 6 months to get the payment. Because banks are involved, he can tell his bank, why not give me the equivalent of the money I'm expecting? Give me in 2 months. So the bank will give. of course, they will deduct their own commission from it. So when the money comes after 6 months, the bank will collect it. So it is possible when two banks are involved because the banks trust one another. So this diagram shows the process. Okay, I'm trying to reduce it a bit. So you can see this is the importer, this is the exporter. The importer is afraid of the exporter. The exporter also is afraid of the importer because of trust problem. So what happens is the importer will need to have a bank. That will be the importer's bank. The exporter will also need to have a bank. That will be the exporter's bank. So these two banks will deal with each other. And by so doing, the fears of these two guys has been reduced. So starting from the step one, the importer will raise a purchase order. He will order from the exporter, I want these goods from your country. So step two, the importer will now contact his American bank, the importer's bank, to request for letter of credit. So once this letter of credit is applied for, then the importer's bank will now pass this letter to the exporter's bank. So this exporter's bank has received the letter from this bank, so he's more confident. So in the fourth step, the exporter's bank will now notify the exporter saying that there is a notification of letters of credit that have been received. Then after the fourth stage, this exporter will ship the product. You can see it is only when the two banks are involved, that is when the exporter now ship the goods to the importer. So after the exporter ship the goods to the importer, then we have the step 6. The exporter will now notify his bank, and also the shipping document and the term draft will be given to this bank. So once the Japanese bank receives all these documents, it will now notify the American bank. So that is how it works. So instead of the importer and the exporter dealing with each other to eliminate the risk, they both involve their banks. So these are examples of commonly issued money market securities that we have discussed. These are the people that issued it. Treasury bills, it is issued by the federal government. Negotiable certificate of deposit, it is mostly issued by large banks and saving institutions. While commercial paper is mostly issued by the firms. So in terms of maturities, you can see they are all within 1 year. They are all within 1 year. In terms of secondary market, you can see treasury bills is highly, meaning that it is highly liquid. It can be easily sold. That explains why many people patronize the treasury bills, especially investors who don't like to take risk. They prefer to buy treasury bills. Even though the return is very low, they are satisfied with that low return. Okay, how does the institution use the money market? So financial institutions, they purchase money market securities in order to earn a return while maintaining adequate liquidity. Yeah, because there are times that there will be sudden need for money. So the financial institution like banks and main banks, in the case of Malaysia, they will always use the money market so that if there is any sudden need, let's say there is a big withdrawal, if someone just withdraw large amount of money suddenly and they realize that there is not enough money, so they can easily go to the money market and probably sell or buy, as the case may be, to offset the sudden withdrawal. Money market securities can be used to enhance liquidity in 2 ways. One, newly issued securities can generate cash. So once a security is issued, purchased money market securities can generate cash upon liquidation. So once you purchase it, maybe after 1 year, based on the agreement, you can sell back and you can collect back your cash. Financial institutions that purchase money market securities are acting as creditors to the initial issuers of securities. Now, I remember during the pandemic in Malaysia, there are times that I will go to the main bank, I will not see money in the ATM. So what happened is that many people withdraw money on that day. So if many people withdraw money on that day, there will be no money in the ATM machine. So the bank needs to quickly look for a way to raise money and put in the ATM machine so they can easily use the money market. They can use the money market because it's for a short period of time. They can get cash and they can put it inside the ATM. Because during crisis period, people are panicking, so they want to keep cash. So it will increase withdrawal. So that is why money market is very useful for the commercial banks in particular. So financial institutions that purchase money market securities are acting as creditors to the initial issuers of the securities. So any financial institutions that purchase money market securities in the secondary market, they are giving assurance that to the initial issuer that they will honor the obligations in the future. This table shows the summary of different financial institutions and how they use the money market. So for example, you can see that the commercial banks and the saving institutions, they hold bank holding companies issue commercial paper, while some banks and saving institutions, they issued negotiable certificate of deposit. They also borrow or lend fund in the federal fund market. They also engage in repurchase agreement. You can see that commercial banks can also create bank acceptance between the importer and the exporter. So commercial banks also provide backup lines of credit. So all of these activities of the commercial banks, of course, generate some income for them. And we also have the finance companies. They issue large amount of commercial paper. So you can see that each of these financial institutions, they specialize in different aspects of the money market. But the commercial banks, for example, the main banks, the CIMB, they actually do a lot. They use the money market a lot. That is why you see a lot of functions for them here. So valuation of the money market securities. So in terms of valuation, the market price of money market security can be represented by PM equals to par value 1 plus K, where K is the required return. So from this formula, you can see that if K is increasing, the money market security price is declining. If K, required rate of return, is decreasing, then the price of the money market security will be increasing. So they are inversely related. And also, a change in the price of the money market security can also be modeled as a change in price of the money market security is a function of required rate of return. Required rate of return also depend on the risk-free rate as well as the risk premium. So RF is the risk-free rate. So risk-free rate is the Treasury Bills because the default risk is low, close to zero, while the risk premium is the risk that the issuer of the money market security may default. So these are all the factors that can affect the required rate of return as well as the risk-free rate. You can see this simple equation here. We can write the statement form of it. All these factors, they affect the risk-free rate. The international economic condition, what is happening. For example, the pandemic. During the pandemic, the whole world was affected. So all of this will affect the short-term risk-free rate interest. The US fiscal policy also will affect the short-term risk-free interest rate, as well as the US monetary policy. On the risk premium side, the issuer unique condition. So if the issuer is a seasoned defaulter, or maybe the credit rating is very low, the risk premium will be very high. Also, the industry where the company operates in. If the condition is very bad, the risk premium will be very high. If the condition of the industry where the company, where the issuer operates is good, the risk premium will be less. So it is the combination of the risk-free rate and the required rate of return that, and the risk premium that give rise to the risk premium. So risk premium depend on the risk-free interest rate as well as the risk premium. And the required rate of return determine the price of the money market security. So it is explaining this. You can see the price of the change in the price of the money market security depends on changes in the required rate of return. Required rate of return is affected by risk-free rate and also changes in risk premium. This one. Changes in this risk-free rate and changes in risk premium affect the required rate of return. Now, the required rate of return affect the price of the money market security. That is why you see this required rate of return affects the price of the money market security. If the required rate of return is high, the price of the money market security will be lower. If the required rate of return is low, the price of the money market security will be high. So this is what this diagram is saying. So what are the impacts of changes in credit risk? So money market securities also have some risk. For example, during the credit crisis, following the Lehman default. So Lehman is a popular company in the United States, very big company, but due to some mismanagement problem, they went into default. So institutional investors were less willing to invest in commercial paper because of the concern that other firms might default. Especially when this Lehman default, many investors became scared of this commercial paper. As a result, many firms were no longer able to rely on the commercial paper market for short-term funding. In order to restore the market, there was an Emergency Economic Stabilization Act of 2008. It was enacted. So this law was able to help to stabilize the money market. In November 2008, in the crisis period, the Fed in the United States began to purchase commercial paper issued by highly rated firms to increase liquidity in the commercial market paper. So sometimes the money market, even though it is for a short period of time, it also has some level of risk. But to make the market to continue, the government will always come in to save the situation. So in the case of the United States, the government came in through the Emergency Economic Stabilization Act, and they also participated in the market directly. So they helped to improve the liquidity in the market. Otherwise, it will have caused serious problems for them. So during the period of heightened uncertainty, investors will shift from risky money market security to Treasury bills. So most investors, they use the Treasury bills to balance their investment portfolio. But when the economy is down, especially like during the crisis pandemic period now, many companies will shift some part of their investment to Treasury bills because no matter the pandemic, government will always exist. So after the pandemic is over, they will always have money, whether they bring the money or whichever way, they will always pay back. So most investors will invest more in Treasury bills because it's less risky. So when the economy is good, they will invest more in other type of securities. So you can see the value of commercial paper outstanding. You can see that in the crisis period of 2002, you can see that the commercial paper outstanding was a bit low. So it was increasing over time. And there was another crisis in 2008. So crisis discouraged investment in commercial paper. You can see that the outstanding commercial paper declined. You can see it declined as low as 1,000. And because of the fear of the crisis, many people will not want to invest in commercial paper. That explains why it is still low up to 2013, because they still recall what happened in 2008, 2009. So crisis period always affect the demand or investment in commercial paper. So the next slide, if you look at all these money market securities, you see that they have almost the same pattern. The reason is because they are all short-term money market security. Particularly if you look at commercial paper and the Treasury bill, the pattern is almost the same. If you look at it carefully, the blue color as well as the green color, almost the same in terms of movement. So they are highly correlated. They are highly correlated. But Treasury bill is still considered less risky. Okay, valuation of money market security. In terms of interest rate risk, if the short-term interest rate increase, the required rate of return on money market security will also increase. And the price of money market security will decrease. I think I have explained this using the equation in one of the slides, that if the required rate of return increase, the price of the money market security will decrease. So an increase in interest rate is not so harmful to the money market security as it is to a longer term bond. So if the interest rate is, or the required rate of return is rising, it will affect the long-term bond more compared to the money market security. So measuring the interest rate risk. So participants in the money markets can use sensitivity analysis to determine how the value of money market security may change in response to a change in interest rate. So some people can do some analysis to see what happened. What if required rate of return increased by this percentage? What happened to the price? So you can see in the next slide. So let's say the interest rate is 3%. So the probability that you will get a value of 97,083 is about 33.3%. But what if the return increased to 3.5? So you can see that with the higher return, the price is reducing. You can see when the required rate of return increased to 3.8, you can see the value decline. So what it means is that as the required rate of return increases, the value of the securities or the price of the securities will be declining. Okay, so the summary. So I give you 1 minute, or okay, 1 minute, so you read to refresh your memory of what we have been discussing. Okay, so the next one. So I give you 2 minutes, read this to refresh your memory. All right, so any question? Or if there's no question, I will upload the video in my YouTube channel so you can download it from there. It will be easy for you to revise when you are preparing for test 2. All right, so see you. So don't forget the strategy. Make sure you are reading. Don't wait for the test 2 to come before you